I have up until recently been doing monthly videos, and I'm going to start doing those again from this month. In fact, we'll probably broadcast this recording for people. I'm getting notes that people can't hear. Albert, can you hear?
I think we're back, Paul.
We're back. Okay, great.
Yeah,
great. And so we'll broadcast those. I stopped doing them for a few months simply because the noise in the data made it just impossible to really pull any kind of a narrative together. But as the markets have begun to calm down again, I think I'll start doing them again because I have some views about where we're going in terms of the economy generally, but particularly on the mortgage business and the real estate business. So I'm going to share my screen and take you through about 15, maybe 20 minutes of presentation. And then I'll talk to you a little bit about our deal flow because from the investors, they're very interested to hear about that. It's been a very quiet summer. I will just give a quick summary, I guess, before we get started. A lot of bidding, but not very many deals being concluded. And what we saw really the ground zero of the flash crash was really into April, end of March into April, maybe even into May, where there was just a huge crash in liquidity. And so everyone was making a dash for the exits. We saw a lot of performing loans selling for what seemed at the time to be absurdly low prices. And in hindsight, certainly were absurdly low prices. But everyone needed cash, and when there are margin calls, then you just sell what you can sell. We then saw through the summer almost no transactions happening. We were the winning bid on maybe 12 or 14 million dollars of capital deployed, and in the end about $2 million of that $14 million was actually deployed because either the seller had issues or there were some other reasons, none from our side but always from the seller side, that those transactions didn't happen. And I think what actually was really happening was as the markets opened up again and liquidity returned, the sellers who had been maybe forced sellers were less forced. And so a lot of those transactions didn't close. We saw then in August, maybe September, transactions starting to pick up again. And I'll just give you at the end a quick run through of some of the deals that we've done. We've a handful that we're still working on going forward. The fund had been closed during the summer simply because we were struggling to deploy capital. And even right now, we've got about $2 million unspent on the balance sheet approximately. We're raising funds again because we're seeing opportunities again that we can start to spend those funds. And indeed, just yesterday, or maybe it was Friday, we closed on a small transaction of actually buying performing mortgages. So the price of newly modified performing mortgages has fallen back quite considerably, and it means that we can pay our investors their preferred return, and we don't have to do any of the remedial work with the loan, which means that we've more capacity to buy more loans where we do have to do the remedial work. So I'll get started. I'm going to share my screen and we'll get going. And then at the end, I'll do some Q&A. So let me just hit this button so it brings it into slideshow mode. So I'm going to talk a little bit about the business overview. I've kind of done that already. Talk a little bit about the economy, a bit about the deals that we're seeing, and then I'll do Q&A at the end. Very important, we are an SEC registered and regulated fund. None of the following is an offer to sell securities. Please read the prospectus and understand, if you're an investor, the risks. This is not a guaranteed return. This is a preferred return. We've been doing this for 8 years now, and our returns to date have been about 16.5% on some funds and 21% on some other funds, but that's no guarantee for the future. You should read the prospectus. You should understand the risks. That prospectus is available from the SEC website if you search the Automation Reperformance Fund, and it's also available at automationfinance.com, which is our website and provides a link to the prospectus and also to our fund manager, who will manage the sign-up process for those who wish to commit capital or increase the capital that they've already committed. So with that done, what is it exactly that we're doing? The Reperformance Fund buys performing and non-performing mortgages, residential mortgages. We do not do commercial. And we work with the borrower to modify the terms of their mortgage so that they can continue to pay if they are not paying at the beginning, or restructure the mortgage to make it affordable if it's unaffordable when we buy it. We've been doing this for 8 years now, and our return so far depends on whether you like ROI or IRR, but it's been in the 16.5% to 21% range on all of the funds that we've done so far. We have never missed a principal payment, we've never missed an interest payment, and every fund that we have run has been profitable, but that is no guide to the future. In short, what are we doing? We're buying first and second lien mortgages at about, well, in the case of first lien mortgages, a 40% discount to the home value. So if the house is worth $100,000, we're buying the mortgage for $40,000. And we then, yeah.
Sorry, were you sharing the slides? I don't think it's being shared to the.
Oh, you can't see this? Oh.
I can't see that.
Okay, well, let me try that again. Share screen. Let me just do this again. Thanks for speaking up.
There we go. Yeah.
Now you're saying
we're good.
Oh.
Yes, we're good.
Okay, well, I won't go back and make everyone sit through all of that again, but really what I was doing was just talking through these slides. So you can still see this, right?
Yes.
Yeah, okay, perfect. So we buy mortgages, we pay a target return of 8%. And how do we do it? Well, if you picture a house, the house is worth $100,000. It has a $100,000 mortgage on it. We buy that mortgage for $60,000. So that generates this 40% discount, which we can use to work with the homeowner. And so we'll pay $60,000. And we have a series of strategies that have been time tested over all the years that allow us to price this mortgage correctly as a non-performing loan. And because we've worked out over 2,500 of them, we've a fairly good idea of how this is all going to play out and what the outcomes are going to be. And so our objective is to get the borrower back on track so they can start making payments again, and that we take the funds that they pay us as their mortgage payment to pay our investors. So it's really as simple as that. The only difference between this and buying real estate is that this is much more scalable. If you were managing 2,000 physical homes, you'd need a team of 50, 60, 70, or maybe hundreds of people. We manage 2,500 homes with 8 core people. So that just gives you an idea of how the business works. This is all in the prospectus. I suggest you read it. Some of these charts have been updated because the prospectus is now nearly 2 years old. But the most current pool that's tracks in the prospectus is in the bottom right, called Island Cap. We bought it for $6 million 2 years ago, just over 25 months ago. We've returned all of the capital in that portfolio, and we'll probably end up liquidating it in total for around $10 million completely. So that will give us an IRR, so an annualized return of about 25% a year. Again, that's probably a little better than you would normally see. Our historical has been right around 17% IRR, and we share that with the investors. So we pay them 8, and we keep the other 7 or 8, depending on the pool. And use that to fund our operating expenses. So what's going on in terms of the business? There's good news and bad news. I won't talk about the pandemic because there's plenty of news media covering that, but I'll talk about it in a sort of a way that is referenced of how that's impacting the market. And the key thing that's been solving a lot of problems has been interest rates. And you've probably seen real estate prices are up 6% year to date, confounding all the predictions from Q1 and Q2. And that's driven by interest rates around 3%, rates that no one has ever seen before. They've never been that low. And the trend is that they will stay in this kind of super low level for the next 2 to 3 years. And as a result, CoreLogic, which is the operator of the largest mortgage servicing platform across the US, so they can see every loan, every payment that's being paid on every loan, and every real estate transactions as new loans are being originated. They're now predicting 7%, just shy of 7% real estate price growth for the year. And they had been predicting basically none. And so that's coming directly from the return of the growth in the economy, but also driven by those super low interest rates. It's great news for manufacturing. You've heard a lot of talk about a K-shaped recovery, the wealthy getting wealthier, but those who are stuck in service jobs, their employers are largely closed, and that's being played out, I think, across the economy. You're seeing a huge spike in new orders from the ISM index as manufacturers restock after having been selling across the last 3 or 4 months, trying to rebuild inventories across the retail and industrial landscape. So that's good news if you're in a manufacturing job, but as we all know, not great news if you're in a service job. So I just pulled this chart from Open Table. I think they operate in every market, but they are an online reservation system for restaurants, software as a service. So you as your restaurant can use their system to book your diners. And you can see there at the start of the chart, it tanks from down to April, and then bumps along the bottom and has recovered about 50%. So we're still half of what the run rate was for restaurant reservations across the whole country back just in January and February. And you can imagine that's 30 million people who work in service industries across the country, most of whom sadly are not working, certainly not making what they were making this time last year. Hot off the press, house prices are booming, that's true, but unemployment rate at the beginning of the year was just under 4%. Now it's looking like somewhere around 9%. And so that's kind of confounding the growth expectations for the future, because I found this just in USA Today. Never bet against America. Look at the number of people who've been forced to change career and why they're changing career. A lot of them being laid off through COVID, but an awful lot of them seeing the writing on the wall that they need more money and that their lifestyle and their income are just not matching up. So people are starting to change jobs, largely through COVID, that's the number one, but lots of other people changing for other reasons. And the last time we saw something like this was back in 2009, 10, and 11 at the Great Recession. But the big difference between now and then is the amount of leverage that was in the economy. So again, I pulled this chart from CoreLogic. If I go back to 2008, most people, the average home had no equity. Most people had borrowed 100% of the value of their home. This time they've borrowed just over 80%. Most people have got about 20% equity in their home. So if they've lost their job or they work one of those unemployed service workers, they still have 20% equity in their home. It's unlikely that they're going to lose that home to foreclosure. More likely, they can take advantage of the rapidly increasing home prices and just sell the house. Now that creates an issue for them as they become maybe a renter, but in the short term, it means they're not facing foreclosure and homelessness. They can get out while the values of their home is still strong. Again, like any business, headlines are all well and good. What you really need to understand is, what's happening when you really drill down into the detail. And so we've one thing in common. We're a gang of data nerds and really digging into the data. And if you look in the newspaper data, you'll see everyone talks about the loans in forbearance that are Fannie and Freddie. And the reason for that is that Fannie and Freddie are about 75% of the market, and they represent the average homeowner, the average home, and the average credit rating across the country. I don't think we're going to see any problems in Fannie and Freddie loans. The government has been very clear that they will extend and provide forbearance for homeowners who are struggling to pay. Okay, fine. So where's the problem going to be? It's going to be in those second columns, FHA and VA and other. And between them, that's about 15% of of all the mortgages. And they have much higher levels of forbearance, and they also have much lower credit score borrowers and borrowers who have not put 20% down when they buy their home. The FHA and VA run programs where with as little as 4% down, you can buy a home. And if real estate prices fall 5%, that means that home is now out of the money and you have a problem, maybe not to the same extent as we had in 2009 and 10, but the same issue. And I think that is the source of the next wave of foreclosures that we'll see coming next. Because while many markets are doing really well, with many of them almost at double digits, San Diego is currently growing at 7% a year, and a prediction that that will go even higher. And that's driven by two things. One, the wealthy are getting wealthy, but also a big lack of supply. We're very active in the Phoenix market. I'm absolutely shocked. In fact, we sold almost everything in Phoenix when we were seeing 5 or 6% growth. That growth is now annualized at 11%. And that's driven by two things: a lot of people leaving California, but also very low inventory. There's been very few permits this year and very little new house building, and that's just pushing up the price of existing stock. But that's not the case everywhere. As we mentioned in previous webinars, the places that got hurt the last time are getting hurt again this time. A lot of the, and this again is CoreLogic's predictions, not mine, expecting 5, 6, 7% declines in many of the markets that really ran up a lot after the last recession. And I think that that's going to be summarized really as follows. Second homes, a lot of places where people have beach homes, that kind of thing. The expensive Northeast, we're already seeing luxury property in Manhattan, where we're based, at fire sale prices. And by that I mean 10 million, 12 million, $14 million apartments being offered as non-performing loans at roughly 50% of those values. And they're selling, they're trading relatively quickly. The oil economies are coming back a little bit, but still a lot of distress there. And unsurprisingly, the beach towns of Florida and the places like Las Vegas also struggling. And I think we'll see a lot of opportunities in both Florida and in Nevada across the next probably 180 days, because this market moves slowly. If you think of the last boom bust cycle, the economy collapsed in 2008. Real estate prices did not hit their floor until 2011. So this business does not turn on a dime, but the trend is in place, and I think we'll see and are already seeing more loans coming to the market over the next weeks and months. So what does that mean for us? We're continuing to build up cash in both in the reperformance fund and in the other funds that we manage. And we also run a book of almost $200 million of assets for other people. So we do manage other people's loans. And we see plenty of buying opportunities for the next 3 to 6 months. We're working on a number of deals now. None of them are the big deals that we spoke about maybe 2 or 3 years ago, where you're deploying 10 or $12 million at a single transaction. These tend to be much slower or much lower capital deployments. $3, $4 million, and a couple of deals we've done in the last weeks have been in the 150,000 to 350,000 of capital deployed. But we're seeing great opportunities in terms of pricing. A lot of sellers doing clear out type sales. So they've stuff that they've had for a long time. They're now using this opportunity to sell it just to clean up balance sheets. Just a house cleaning rather than to generate cash, because the sums involved for the sellers are relatively modest. And we're seeing banks and other institutions telling us, look, we're going to do a sale this year, and we expect several of those to close before the end of the year. I've already talked you through how the business works. I'm just going to talk you through Some of the deals that we're working on at the moment, since the beginning of the year, we've bought 420 loans. That's about $26.6 million. And that's across a bunch of loans. So this first one, PM, these are just our internal monikers that we used to keep track of them. That deal closed in February. It was a $5 million deal. We're working with that seller again. We'll close before the end of the year. It's a $14 million deal. And these are very attractive loans in that the owner has owned them for 7 or 8 years. They're all in litigation, which many buyers shy away from. We actually love them because all litigation can be solved. It's just a matter of money. So if you buy them at the right price, you can do pretty well on them. So the average balance is about $500,000. So they're big loans, a small number of big loans. In June, we closed a series of transactions, which we call Brink 1, 2, and 3. 108 loans, followed by 65 loans, followed by 82 loans. And again, these are very troubled, a lot of collateral issues, which means the paperwork is not in great condition, but we paid very, very low prices for them. And so you can pay a higher price and get very good quality paper, or pay a lower price and roll up your sleeves and fix all of the issues. And so that's what we're doing right now. And so fortunately happens to be one of my hobbies. So we're digging through those loans week after week. Line was a small deal, just 4 loans that we concluded almost in August, just the end of July. Further 3 followed in also in July, another 3 in August. 127 in September. This is a very, very good deal. It was an off-market transaction where the seller came and said, look, these are 127 loans. They're the end of the barrel. So the loans are, many of them are paying or have been making spotty payments, and they only owe an average of $20,000. So the homes might be worth $300,000 or $400,000, but the borrower only owes $20,000. That's a very unattractive loan for a financial institution to own, because they're not going to foreclose or start legal work when they're only owed $20,000, because the cost of doing the legal work might be $5,000 or $6,000. However, we're set up to do that at low cost, and so that's what we do. So we think that we can. We paid about $350,000 for $3 million of face. And the balance on those loans is almost $6 million. So we think it won't be fast, but I think it will be very profitable, assuming everything goes, or even a few things go according to plan, because when you buy a lot of loans for a low price, you have a lot of room for error. And then lastly, 3 loans that closed just a couple of weeks ago. They're actually performing loans. We bought those, and they're generating 13.5% or 13.6% return the day we buy them, because they're already performing. So that's the kind of deals that we've done so far this year. We'll probably deploy another $7 or $8 million before the end of the year. That's assuming none of the big trades that we've been working on for quite a while happen. They may not happen till next year, but quite a good hopper of deals so far this year. So we're pretty happy about that. And to give you an example of one, this was a deal that almost closed earlier in the year, and the borrower came back with an even better idea. So there were 3 families living in the home. They'd been trying to modify it for a long time, and we'd agreed that we would actually restructure the loan and give the homeowner a new loan, basically modify the terms of the loan that they have, but allow their son, the mom's son, to take over as the borrower. So we would substitute the parties on the loan. And that was great. We were perfectly happy to do it, and it should have closed 3 months ago. But the son came and said, I can actually get a whole new mortgage. So we're closing on Friday. I just signed the documents today. So don't want to count our chickens, but it's looking pretty good. And the loan is being refinanced for $700,000. So we bought it in February for $460,000, and we should close on Friday for $700,000. So that's now that's very rare that you see a deal that good, but when you've got good news, why not share it? We've lots of others where we only make 5 or 6%, so they're not always this good, but this one is particularly good. And so I'll stop there, and I'll see if people have questions, and we can move on. And I'm happy to discuss any questions that people may have. I'll stop sharing my screen. I think that's this one, and let's go back to this.
Okay, thanks, Paul. So for questions, please feel free to enter them in the chat, or you can unmute yourself and speak to the audio, and we'll try our best to go through them first in, first out. But let's give it a go.
Let's see, has anyone got the courage to ask a question? Because it's always hard. I recognize a few names. I'm surprised they haven't jumped in with some comments already. Am I actually getting away with no questions, Albert?
I haven't seen any. Anybody has a question, feel free again to type them into the chat, or you can unmute yourself and
I'm more than happy to end early and go to lunch, so that's fine.
All right, here we go. If you look at the chat, Paul, there's a question from Tony Dune.
How do I see the chat?
If you go to the bottom of the screen, usually, so there's a chat bubble in the Zoom.
Participants 24, recording.
It's just next to participants. And
participants, new share, security, stop video, mute. Would you mind reading out some questions?
Read it out. So this is from Tony Dunn. Sorry if I got the pronunciation wrong, but what is your greatest concerns at the moment? What keeps you awake at night about the portfolios?
I think there's nothing really keeping me awake at night. I think that the Fed and the Treasury have made their intentions very clear. There's not going to be an economic collapse. And so the question really is, how do we get from where we are to a new plateau of growth? The thing that keeps me awake is not really about the portfolio. It's about the global economy, I guess the US economy in general, which is we just have too much debt, and solving too much debt with adding more debt, it doesn't end well, but we can continue to do it for many more years. I think that the key thing for me is making sure we're positioned when the banks start to sell. What will happen is banks will get approval to sell loans, and they'll want to transact quickly. They don't want to go through prolonged bidding processes and auctions, because that creates bad headlines, and it's not good. They don't like that dynamic. So being able to close quickly is the key thing. And so that's why we've decided actually to reopen the fund. We will be doing a Wall Street type fund, because the amount of capital we're going to need is probably going to be too hard to raise just using the Reg A crowdfunding. But that's really what keeps me awake at night. I think the fund is, I think there's going to be significant asset price inflation of all assets except hotels and retail and Class B malls for the next several years, because the amount of cash that's coming in is just going to force those assets up. It's a great time to be a homeowner. It's a great time to be buying non-performing mortgages on homes where the value of the home is going up every month, because that's a much easier conversation to have than to talk to a borrower where the value of the home is flat or down, because you're trying to convince the borrower to do something and they're saying, well, hold on a second, the value of this house is going down. I'm just wasting the money. I should become a renter. So I think that access to funds and access to deal flow, making sure we're well positioned. That's the key thing for the next 180 days.
Okay. We have another question, actually a couple of questions from Michael Jones. I'm just going to read both of them to you, Paul.
Yeah.
First one is, what discount are you buying seconds at? I'm assuming that's second lien.
Yeah.
And then the second part of the question is, do you think reperforming inventory after COVID will be much higher than NPLs?
Well, so let me answer the second one first. So our exit, we used to buy these loans, like this time last year, I would be telling you, hey, we buy these loans, we get them reperforming, we season them, which means we hold them for 6 months or 12 months until the borrower's in a payment process and shows a track record, and we sell those loans for 85 or 90 cents. That business has completely gone to zero. So typically we would have maybe 30 or 40 performing loans, maybe 50 performing loans on our books at any one time. Right now we have about 200, excuse me, because we can't sell them. There is no bid for those reperforming loans. And the reason for that is the buyers who are paying 80 cents or 90 cents on the dollar are saying, well, hold on, if these guys stop paying because of COVID, it's going to go back down to 60 cents again. I'm going to lose a fortune. So we're holding all of those loans. And I'm fine with that. In fact, we're buying from other people, which is something we had never done. I don't think we've ever bought performing loans until the last 2 months. But the prices have come back quite a bit and we're happy to buy them because I firmly believe that house prices are going to continue. They're going to go flat or up. They're not going to crash. And so that's a good buy to be buying that paper if you can buy it at a good price. What discount do we buy second liens at? Well, it depends. If you're buying in a competitive auction setup where you're bidding against other people, you're paying a full price. If you're buying it in an off-market deal, like that 127 loans that I bought in August, I was the only one who saw those loans. And so it was a matter of terms, what terms were we giving? And what did we want from the seller? Because the seller wanted to say, I'm not giving you any guarantee with these. I'm just giving you a bag of paper and you're giving me money. And if you've got problems, I don't want to hear from you again. So it really depends on what it is exactly that you're buying. We do extraordinarily detailed and high quality due diligence. So when we buy, we feel very comfortable that we know there are problems, but we know what the problems are and we feel confident we can solve them. And that's reflected in the price. So a discount on a non-performing second lien can be 50% or it can be 93%, depending on the nature of the loan. It's not really, there isn't a single type of loan. Bankruptcy makes a big difference. Whether the senior lien is performing makes a big difference. Whether there is equity in the loan for the borrower makes a big difference. What the litigation history is, what state it is in. We just turned down a deal in Hawaii, which looked like a very, very good deal on first inspection. But when you dig into the details, you find there's a fundamental flaw on modifying that loan, and you could lose all of your money. And indeed, it's our belief that we probably would have lost all our money, so we didn't buy it. So there's no easy answer to that second lien question.
Okay, great. And Michael said, thanks. Just a couple of comments here from Joshua Andrews. Thank you for the market update. Wonderful info as always, Paul. And Sean Bagley, great information. Thank you for sharing. Oh, I don't see any other questions on the chat at the moment.
Hey, Paul, I do have a question. This is Barry.
Oh, hi, Barry.
Thank you very much for your great insight. And actually, in fact, I was missing your the session for some time, and I sent you an email as well, and you replied to me. So thank you very much for getting back on these sessions. So they're really I would say really, really helpful, first of all. So thank you very much for that. I do have a question actually. So since you're talking about inflation, right?
Yeah.
So for example, I was looking, I'm an investor in your fund as well. And at the same time, I was looking for, for my own home as for I think a couple of months now.
Yeah.
But the market is, I have no idea what's going on. People are buying in cash, and I'm in Atlanta, by the way.
Right.
So I have no idea where the heck this cash is coming from, what people are doing.
Yeah.
Like on one side, there's a lot of layoffs and all that happen, right? And
Yeah.
at the same time, this is completely opposite, which make me crazy. Like, what's going on? You pretty much answered some of the question. So I just want to understand, like, where these people bringing this cash from if there are not many jobs around? That's the question number one. And when you talk about the inflation, what do you mean with the inflation? I understand the concept of the inflation, but right now, let's say interest rate is, let's say, around like 3 or whatever it is. Do you think it's gonna be 6? Like, yeah, well, I hope if I conveyed my question well. So that's pretty much my question now.
Well, firstly, thank you for investing. We need more people like you, Barry. So let's take them in order. So firstly, Atlanta. Atlanta's a very hot market. Lots of people moving there, good job growth, and a great place to live at low cost relative to places where people are coming from, places like New Jersey and Pennsylvania and the expensive Northeast, let's say. So that's the first thing. Second thing, asset price inflation. There's inflation in 3 places. The first one is education. So the cost of going to college is ludicrously expensive and growing way too quickly. Medical costs are ludicrously expensive and growing way too quickly. And asset prices. So the price of a quart of milk is not going up so much, but the price of assets is going up. And that's being driven by the K-shaped recovery. And what I mean by that is people who've got jobs who work in anything other than service industries. Service industry people tend to be renters. They tend not to be buyers of homes. So it's almost like they've been kind of red circled out of the market, and everyone else is moving out of cities to the suburbs. People say to me, well, why do you live in Manhattan? Well, I live in Manhattan because it has great restaurants, it's got great bars, there's lots of stuff to do. I'm a single guy, there's a lot going on, it's a great social place to be. And yeah, the rent is really expensive, but that's life. Well, what happens if you take away the bars, take away the restaurants, take away all the social stuff to do? All you're left with is really expensive rent. And a lot of people are leaving expensive places and moving to places like Atlanta, where you can buy a fabulous house for $250,000, the home of your dreams for $250,000 for many people coming from the Northeast. So, and that's a problem, and that's pushing up prices. And home price inflation in Atlanta right now is in that 6 to 7% range. Will that drive up interest rates? Well, maybe, because the problem is the growth in the US economy in general, the overall economy, not the financial economy, Main Street economy, is very sluggish. And low interest rates help businesses with too much debt to keep going. So the Fed has got a big problem. Yeah, housing market is running hot, and so I should put up interest rates. Well, if I put up interest rates, sure, it'll cool the housing market, but it will mean that the bottom 20% of corporates can't stay in business because they're relying on 3% interest rates to make their business work, because their business doesn't work at 5 or 6% interest rates. So that's my view, and that's, maybe I'm right, maybe I'm wrong. I don't know if you're going to see 6% interest rates in the next several years, many, many years before we get back to that. I think for the next 3 or 4 years, we'll be in that 3 range for quite a long time.
I appreciate that. Thank you very much for your insight. Thanks a lot.
Thanks for the question, Barry. We have a question from Nick Musseri. He said he thought he saw Prescott, Arizona on the list in one of your pages, Paul, of areas in danger of dropping.
Yeah.
He's asking whether this is accurate and what is the source of the danger.
Well, the source of the danger or the source of the data?
It says source of the danger.
Well,
and Nick, you can also unmute yourself. Please feel free to do that, and you can clarify the question over audio if you want to.
Okay, I'm here.
There you go. Yep. Go ahead. You want to ask your question to Paul directly?
Well, I live in Prescott, Arizona, so when I saw it come up on the list, I was wondering, why it was on there.
Well, I have to say, I had never heard of Prescott until I pulled that data. So honestly, the answer is I don't know. But it comes from CoreLogic. And if you can just Google CoreLogic Black Knight report, and you can dig into the data and look at it and see. You might even understand. You'll know more than I will, because I've never even heard of the place. But it made sense to me, because when the last time there was a big run up in prices, they plateaued for a while. And a lot of we were a big buyer in one of the subdivisions on Camelback Road, which is the main east-west highway in Arizona. I can't or in Nevada. I can't remember what was the place. Paradise Valley in right there. So I don't know. I'm happy to dig into it. I'd be interested to know. Is it a big city or small city?
Small town, 100 miles from Phoenix. It's got a large retirement population, and prices have been going up here.
Wow. Yeah, I just don't know, but it's very interesting. I'll take a look after this, and maybe I can find out something for you.
Okay, I'll look it up too. Thank you.
Sure, pleasure.
Okay, again, if you have a question, you can type it into the chat or unmute yourself and speak to the audio.
Richard, if you hear Matt talking about that, there has to be some room for discussion with people like.
Okay.
Well, maybe we're done, Albert.
Yeah, I don't see any more questions.
Okay.
But again, as always, we will upload the recording to this webinar on our website, automationfinance.com. Just click on to our insights section, and we will also put the materials on that link as well. And we are always open. If you have any other questions, go to our website, send us an email, or give us a call. We'll be happy to follow up on your questions.
And also, because I see our SEC attorney is on the list, can everyone make sure that you read the prospectus if you're considering investing, and make sure that you understand the risks. This is not a guaranteed return. This is an 8% return paid monthly, but it's best efforts. Now, we have paid it every month since we began, but that's no guide to the future. And we do offer best efforts liquidity, which means if you want to withdraw your money, we can work with you to do that. There are some terms and conditions for that withdrawal, but just to let you know that we do that. The fund is back open now. We'll continue to raise until the completion of the raise period, which I think is next May of next year. And we'll be buying non-performing and spotty pay mortgages and pay a preferred return of 8% to our investors, and we pay that out monthly. Or if people would prefer to leave the funds in, they can get 8% on the 8%, continue to earn interest on the 8%. And we will be happy to work with you. If you have any questions, come to me or come to Albert. Happy to answer any questions you might have. It's a very important day. I hope everyone who can vote gets out and vote. There's so many people in this world who don't get to decide who makes the rules. So it's a wonderful exercise of our rights. Thanks for coming, and we'll talk to you, I guess, again next month. And I'll be posting my updates every month from now on. So thank you, and have a great day, everybody.